Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. Let's get right to the charts. First market, the Australian US dollar, Aussie. It looks to me like it's trying to carve out support here longer term, pop out to a monthly. You get a better idea where that market's come from. You're perched right on the 66% retracement of that entire bull market from '08 on into 2011. Then you've had a nice two-third correction of it, so that's definitely a natural area on the chart for a pause. Drop back down to a daily chart, and you can't rule out some kind of a counter trend rally similar to what we had around the same time last year. So this is definitely an area on the chart to watch. If you if we scroll down to a 240 4-hour chart, there you can see there's some support bunched up. That'd be definitely an area I'd be watching. 77.22. Next market, dollar Swiss. We're big on following the golden rule of trading, and that's buy dips and uptrends and sell rallies and downtrends. Here's a dip to buy. There's your Swiss franc, the dollar Swiss. It looks to us like you have pretty good support there, and it's going to be a market to watch. Let me scroll down to a 4-hour chart. Market held long-term support beautifully. You had a nice hammer doji. Technically, this would have been a buy signal on a 4-hour chart. The market's backing down. It's holding support again, so you ended the week on a higher low. So that's going to be worth watching. If this market starts to track higher, then we'd want to go along with that. So from our perspective, dollar Swiss looking pretty good. You're on support. There's no doubt about it. These markets are data driven. I love that expression that the Fed is using. The Fed is saying, hey, they're going to raise interest rates, yet they're data driven, meaning they're waiting for good news. And there's no doubt about it. The markets are the same way. We're dependent on the fundamental news that economists measure to determine the health of an economy. So no doubt about it, we have to be aware of those numbers coming out. Speaking of that, here's our dollar index. Similar to the dollar Swiss, we see the market on support. Again, drop down to a 4-hour chart, and you see the market holding that support nicely, and you see the market putting in what could be potentially a higher low right here. From a trader's perspective, we love that. We think that's very interesting. However, again, it depends on your economic numbers. We've been seeing weaker economic numbers. That doesn't surprise us at all. You pop out to a daily chart, and just looking at the calendar itself at the bottom of the chart, I'm going to tell you the slowest time for U.S. retail is following the holidays here, January, February into March. So it doesn't surprise us that you've had bad data, and no doubt about it, markets are data dependent, as we always say. So I wouldn't say it's bad data, but you just had U.S. economy putting up a little bit slower economic numbers than a lot of economists predicted. That's not a big deal. That's a rear view mirror number. If anything, by the time the March retail sales number comes out, you're deep into April already. By the time the April number comes out, you're into May. So you don't want to get too excited about any individual number here, especially given the lull, that seasonal lull that's pretty normal in the economy. So we like the dollar index. You've got support just below. We're long-time bulls on this. On the other hand, we have the advantage of being traders, and here I'll show you what I mean by that. Here's our benchmark. This is our short-term benchmark. What's nice about these 3 trades, there we go, the numbers are a little bigger for you. Made money short the euro right there. The next trade, we made money long the euro. So we're trading both sides of the market now. Essentially, we're doing what the market tells us to do. So just as markets are data dependent, as traders, we're essentially dependent on what the market does. We base all our trading decisions on market movement, essentially based on the market's high, low, and close for a specified period. So that's what you're looking here. Our benchmark method, it's not based on what we think, it's based on what the market tells us. And sure, you get in counter trend markets. You saw February, you had a lot of sideways action, and our winning percentage dropped down. Similar, we started to see counter trending action at mid-March here. You had a couple losers in a row, but once things settle down, you have the freedom to be both short the euro and long the euro. It made money, our first long trade of the year in the euro where we made money, and that's not our decision, that's just the market itself, which is pretty cool. So markets are definitely data dependent, and we're price dependent. So dollar index, we still like it on the long side. However, if we find ourselves in a position where we're taking sell signals, we're not shy about that either. And I tell you what, if support does not hold, we will definitely be seeing more sell signals. So it doesn't bother us to go long or short. We're not too sentimental about trading either side of the market. Here's the euro, and here's the daily chart. The euro, you can see good resistance ahead. The euro couldn't even get to it. If I'm in the camp of expecting a euro correction here, short covering rally in the euro, I'd have to be disappointed that you really couldn't crank one out. You're still below the 50% of this last impulse move down. You see that last sell-off, sharp sell-off in the euro. You haven't really gotten beyond a 50% retracement of that. You really need to get beyond 2/3 of that retracement to think you have any kind of upside. So euro longer term, we're definitely still in the bear camp. We'd still be interested in selling any rallies into that resistance right there. But on the other hand, as you saw in our spreadsheet, we'll trade both sides now. So we actually had a winner this week being long the euro. So we don't mind seeing that at all. We don't mind trading both sides. We're traders. Sometimes investors have the advantage in a long-term trend, and when things start to slow down, sometimes the advantage switches to traders. We're both. Our methodology essentially identifies which environment that you want to focus on, a longer-term trader, an investment environment, or more of a trading environment. We see ourselves slipping into more of a trading environment right now. Hey, there's gold. No doubt about it, we're still bared up on this market. You got pretty good resistance up above. You cleared out some short-term resistance in here, and gold looked like it had a little bit of legs earlier in the week. However, you still have good resistance up above. There's the 50% retracement of this down move, that purple line, so you haven't even got to that yet. So we're definitely still in longer term sell the rally camp. Gold, on the other hand, just like all the other markets, it's in a position where, yeah, if it gives us a good looking buy signal on a shorter term trade, we'll look to take advantage of that. Hey, last market we're going to take a look at the 10-year note, 10-year interest rates. Look at how beautifully that market topped out here. Gave us a nice lower high relative to that high earlier in February. So we think this likely is a major long-term top sea change move for the interest rates. You can see Friday you had a green candle. Madam Yellen spoke. Fed chairman spoke on Friday, so I don't think a lot of traders were crazy about having to carry a position through her speech, which is late in the session, so you saw it short covering throughout the day, produced a green bar. However, we think longer term this could be an excellent area of the chart to set up long-term shorts. We're calling for a sea change move in the bond market. Finally, you're going to put in a top in the 10-year notes and the 10-year bonds for this massive bull rally. This is a monthly chart you're looking at going all the way back to 2000. So we think right here, that's the first lower high in a sea change move lower for the treasuries, U.S. Treasuries, i.e. higher interest rates in the U.S. Hey, thank you so much. Always good to see you. My name is Jay Norris. I teach at Trading University. We'll see you here next time. Bye-bye.